Walk into Rockefeller Center in New York, and you will find the headquarters of Chimera Investment Corporation. They do not manufacture physical goods or sell software. They manage a portfolio of residential mortgages and agency mortgage-backed securities, capturing the interest rate spread generated by millions of everyday suburban housing loans. This dashboard highlights a massive pricing contradiction. The stock trades near $12.90, yet the company reports a GAAP book value of $18.34 per share, all while paying out a near 14% dividend yield. Run this ticker through any standard stock screener, and the algorithm will likely flag it as a failing value trap. That is because Chimera reports a trailing GAAP earnings per share of negative 81 cents. But negative 81 cents does not reflect the cash entering the building. Look at their earnings available for distribution, or EAD, and the company generated a positive $46 million, or 54 cents per share in the first quarter of 2026 alone. Standard GAAP net income forces the company to mark their securitized debt to market, dragging down reported earnings on paper. EAD strips out those non-cash accounting adjustments to measure the actual cash the portfolio yields. To find out if this highly levered financial instrument is a deep value opportunity or a yield trap, we are going to run it through the strict criteria of 3 historical value investing legends. Warren Buffett demands durable competitive advantages. He isolates businesses that can dictate pricing power and defend their market share over decades. Chimera fails the economic moat test immediately. Mortgage real estate investment trusts operate as commodity spread businesses. They are absolute price takers in the credit markets, with zero ability to dictate consumer interest rates. Buffett also evaluates management competence. Recently, Chimera's executive team proactively redeemed 8 legacy securitizations, a move that successfully freed up $195 million in tied-up capital. They immediately redeployed that $195 million into higher-yielding agency RMBS. Securing a higher forward return on trapped capital earns management a passing grade for capital allocation. Then we hit the debt test. Looking at the balance sheet, the scale of leverage required to run an MREIT is staggering. They hold roughly $15.9 billion in total assets, supported by $13.5 billion in total liabilities, pushing their total leverage ratio to 5.2 times equity. That leverage creates severe turbulence in their returns. Over the past few years, trailing return on equity collapsed from over 9% down to less than 1%, failing Buffett's requirement for earnings consistency. Buffett focuses on owner earnings, the cash an owner can actually extract. Since GAAP earnings are distorted here, the 54 cents of EAD per share serves as our closest proxy for true owner earnings. The management team is competent and the cash flow exists. However, the lack of an economic moat, volatile accounting earnings, and a heavy reliance on a 5.2 leverage ratio trigger a strict avoid rating from a Berkshire perspective. Peter Lynch categorizes companies into specific behavioral types to determine the exact valuation strategy required. Chimera falls into 2 categories. First, it is an asset play. The stock trades at an extreme 0.7 multiple to its stated book value. Second, it operates as a cyclical. The firm's book value and spread margins are hypersensitive to interest rate volatility. We can see this maturity in the PEG ratio. A forward price-to-earnings ratio of 6.14 combined with a PEG of 1.52 implies a very low growth rate, which is standard for mature, high-yielding REITs. Lynch also demands liquidity safety. Chimera holds $476 million in cash, alongside roughly $200 million in unencumbered assets. That safety buffer is strictly necessary because it sits against $6.9 billion in secured financing agreements. Lynch historically avoided timing macroeconomic cycles. Because Chimera requires precise timing of the interest rate cycle to maximize returns, this framework yields a hold. Benjamin Graham strips away the narrative and focuses purely on quantitative, defensive metrics to find deep value. Running his defensive checklist, Chimera passes the size requirement with a $1.08 billion market cap and easily clears the price-to-book requirement, trading at 0.7 times book, well below Graham's strict 1.5 limit. This equation is the Graham number formula. It calculates intrinsic value by finding the square root of 22.5 multiplied by earnings per share and then multiplied by book value per share. Plug Chimera's negative 81 cent GAAP EPS into the equation, and the math breaks. Multiplying by a negative figure results in an imaginary number. To evaluate an M-REIT properly, we have to swap the distorted GAAP EPS for the annualized earnings available for distribution, which gives us $2.16. Executing the formula with the $2.16 EAD and the $18.34 book value results in an adjusted gram value of $29.85. At a $12.90 market price, Chimera offers a massive margin of safety against its $29 intrinsic value. For investors willing to stomach the balance sheet leverage, this is a classic cigar butt cautious buy. Traditional discounted cash flow models using unlevered free cash flow are useless for a financial firm, since investing and financing are their daily operations. Instead, we will use earnings available for distribution as a proxy for free cash flow to equity. To build a conservative base case, we assume 0% terminal growth and apply a steep 12% discount rate to account for the leverage risk. $2.16 of annualized EAD divided by a 12% discount rate yields a fair value of $18 per share. This sensitivity matrix models how the valuation holds up if our cost of capital or growth assumptions are wrong. Even under a punishing 15% cost of capital and 0% growth, the value holds at $14.40. Drop the discount rate to 10%, and it jumps to $21.60. Cross-verifying with the dividend discount model, we can take the current $1.80 annualized dividend, assume zero growth at a 12% cost of equity, and arrive at a $15 fair value. Historically, Chimera trades at a multiple of 0.8 to 0.9 times its book value. Applying a conservative 0.8 to the current $18.34 book value yields $14.67. Whether we use adjusted cash flows, pure dividend discounting, or historical multiples, all empirical models point to a fair value range between $14.40 and $18, well above the current trading price. This synthesis table aggregates the final outputs from our valuation models, displaying the market price against our strict quantitative estimates. An investor buying in today locks in a 14% dividend that is currently covered 1.2 times by actual distributable earnings, while purchasing assets at a 30% discount to GAAP book value. But the structural risks are heavy. The firm operates at 5.2 times total leverage, remains hyper-exposed to interest rate shocks, and relies on complex mark-to-market accounting that forces negative GAAP prints. Buffett avoids the leverage. Lynch waits out the cycle. Graham buys the margin of safety. In the hybrid M-REIT sector, the battle is always between accounting reality and cash reality. At $12.90, the market is pricing in maximum accounting pessimism, creating a structural deep value opportunity for those willing to underwrite the cash flow.